To me, fundraising and investors are more a pain in the ass than anything else.
So software engineering, as we know it, is over. Something else is coming?
If you find the right person and you make the right combination of mouth noises in the right order, they will give you money.
The VC money that gives you that gunpowder that allows you to go to war with the rest of the world.
Today, we're going to talk about taking ideas to investment. I'd like to formally introduce Rik, who is the founder of vibecode.fun. We're hosting this event, and it is an absolute pleasure to be here and wrap up the week in this way. And before we actually get started, I'd like to ask a question, and please show by a raise of hands how many of you are currently on your startup journey in your own company. All right, we've got maybe a dozen people. Awesome. And then how many of you are raising funding right now for your company? Almost nobody. And this is exactly the type of discussion we want to have, right? Because maybe some of you are considering, how can I think about maybe bringing on some capital in some way to grow my business? And when we talk about fundraising, it's not always just what you kind of hear about in the movies or through friends or tangentially in the startup landscape. I have to go to some VC like A16Z. There are many different ways of which you can think about trying to bringing funding into your company if that is what your journey kind of looks like. So let's go ahead and kick this off formally. I'm going to go down the list of panelists, and I'd ask you guys, each of you, to introduce yourselves, number one. Number two, give the audience members some idea about your experience in raising funding for your own company or helping raising funding for another company. And give us a little bit of a shout out about what you're currently working on. Dan, let's start with you.
Microfork at the ready. So, hello everybody. I'm Dr. Dan, and I have a background in artificial intelligence. I have a PhD in this. I used to hang out at multiple companies and eat their free food, which they called a job, and they paid me, including Google. And I have several VC-backed startups behind me. I would say, at the very least, 2 of them meaningfully funded. Let's say 3 or 4 if you include scraps from like angels and whatever. What was the second question or third?
I think you covered it. Yeah, you're
All right.
talking about what you're doing and your experience in fundraising. And, let's add another little question. Thinking back to your entire sort of experience around fundraising, how would you wrap it up in one word or phrase?
A nightmare.
Hi, so my name's Luca, and my first company I didn't raise funds for, but I eventually exited. And it was a tourism company, and I had exited to a tourism company too. So they had acquired my tourism product. But my first time fundraising was doing my first tech startup. And similarly to the first company, I ended up fundraising from my biggest client. So I always tended to end up fundraising from somebody who already knew my business rather than somebody who never knew me before. That was the first time I did it. And if I had to kind of think about it in terms of how it happened, it was always coming up with a much bigger vision than I thought I could achieve. And I always feel like European startup founders are a lot more humble than American startup founders. And I feel like you almost need to really have this over-the-top vision to actually fundraise, and that was always what I did. So my last company I fundraised for was a company that was called Better Studio. I had started out as a solopreneur doing a business where I was offering services to fashion brands. We were creating fashion photography for their e-commerce websites. And then I pitched this company to another business that's called Better Pick, and they were doing AI headshots. They were doing hundreds of thousands of euros per month, and they acqui-hired me. So I joined their team. They gave me equity in the company, and the reason they gave me equity was because I had this big crazy vision, and I told them we're going to build the Spotify of fashion photography, and we're going to license all of the supermodels, and we're going to sell the licenses of these supermodels to all the biggest fashion brands in the world, and we're going to partner with the model agencies in New York and in London. And we managed to raise 2.5 million on that vision and the revenue of the established product. So that was that experience. Yeah, but maybe we'll go into it a bit more later.
And now, Luca, one word or phrase to summarize your experience within the world of fundraising.
I feel lucky because I never struggled in the fundraising.
Lucky.
Yeah, I
Lucky is a good
feel
one.
lucky. And when the check was written, I was like, oh my God, that's so much money. What the hell do I do with it? And I still think that I had no idea what I was doing with it once they gave it to me. So if you don't feel ready to ask for $1 million or $5 million, neither was I. So I guess you're never going to feel ready to ask for those large sums. And I guess you don't have to feel ready. You just need to kind of be brave. And this is why I made that comparison between European founders and American founders. We seem to be a lot more hesitant to ask for that, whilst the American founders are like, yeah, I deserve this, give it to me, you know? And I think you need to have that attitude if you're going to ask for it.
So that's why Europe is lagging behind.
Now, Rik.
My experience back in 2021, actually, when I was working for the same company as Sasha, we helped founders. We were working for a venture studio / incubator, where we helped founders to raise funds. I was the marketing guy there. After I was done there, I've done a similar position at another fundraising platform. After which I usually got hired by startups to pre-seed who wanted to raise money. So then I'm the guy who has to structure the decks, has to make sure that everything is in order so that the founders can raise money. So that's my experience in fundraising. Myself, have I raised myself? No. And do I want to fundraise? Maybe not, unless I'm at a certain stage that I need the money for actually growth, like investing in growth. Then I think it makes sense. But to me, fundraising and investors are more a pain in the ass than anything else.
I love it. And that's the kind of, like counter positioning I want to hear in this. And in your experience in helping a lot of the companies that you and I have actually been helping for a while, how would you sum that up in one word? Big sigh.
Yeah, maybe.
I think that's enough. Yeah. And so I think Rik kind of leads us to our next point. Before we do, I want to introduce myself as well. My name is Sasha. I am one of the co-founders and general partners of Arcanum Ventures. It's a venture capital investment fund and a venture studio. We invest in a number of companies, mostly within technology and data infrastructure. And we also incubate and advise companies as well. And we've been doing this for a number of years. And before that, Rik and I actually met working at the same venture studio. But it does take us into our next point, what you had mentioned, Rik, because before we talk about fundraising and how to fundraise, one of the biggest questions that's often overlooked by many people, especially in today's landscape, where it feels very much like a hustle culture. I've built a product or I've built a company around a service. Immediately, the same three buzzwords kind of come to mind, right? Scale, expand, and build. And many people think in order to do this, you need to onboard funding and maybe through venture capital. But what they don't ask first is why. And so I want to take this question over to you, Dan. I think I'd love to hear your opinion. What are some of the right and wrong reasons that you'd want to think about for raising funding for your company at a startup stage?
Wonderful question. So my experience has been the reason we were raising money was to hire people. It was always some kind of software. I've always been, every time there was a VC involved, it was software. And that's the right category for VC, right? It's the one that historically has provided the outsized returns that justify the business model, right? You can explain to those not familiar with it, if you want, the dynamics of a VC fund and how you're basically taking really risky bets and you're hoping that one of them will return the fund, will give you 100x, a 200x exit. So all the ones that go to zero don't matter, right? Because most of them go to zero. Like maybe you have 30 investments and you're hoping one of the 30 will go to, is that right?
Yeah.
20, 30?
Yeah. I mean, on average, like anywhere from 90 to 95% failure rates of startups. So it's a rough road for sure.
Right. So every time I raised was for software. Okay. Back in the day, that made sense, right? Because building software was expensive. That's why we're here for the vibecoding thing, right? Because that has changed. Because you no longer need to hire somebody with a six-figure salary who also thinks he's some sort of diva, right? That you need to provide free food for and massages and stuff. Like I've experienced this, and it was amazing. But it was the kind of leverage that the really scarce, highly qualified workforce of computer science used to have, and now it's going away. It's going away because the sort of stuff that we used to do with the machines, which is whisper to the machine in parcel tongue, right? That is gone. We don't need it anymore. You can just talk to the machine like a human, and it will do your bidding. It will build things for you. So software engineering, as we know it, is over. Something else is coming. There will still be humans involved, but not as many humans, not as extremely well paid, not as scarce, right? And so do you still need to raise VC money today, right? And so back in the day, 100%, you couldn't do without people. And now my personal belief is for 99.99 of things that you want to build, you do not need it, right? Now, where would you need it? And I know you didn't ask this, but let me just throw it in there. A good friend of mine started a VC fund recently. He had a previous one before, and he started a new one. And this new one doesn't invest in the traditional sense. It doesn't like get shares. What it does is revenue share. And what they invest is marketing money. They see something that works. It's a repeatable sales pipeline. You know, this company has it. They figured it out. They have product market fit. All they need to grow is more marketing, right? So you lend them the money to do the marketing, and then you take a percentage of the revenue. So that's what I think of VC nowadays.
That's very interesting. I want to take this question over to Luca as well. And lingering on the question of why, in your own experience in raising funding, I want to really kind of tie this back to practical advice and lessons that we could offer people that are listening here today, and also people that might be tuning in later on video. When we talk about the why, from an investor perspective, because you've sat at these tables, you've had to justify your business and defend it in a very hostile environment when you're pitted against an investor. What are they looking for to understand when you ask them, I need $1 million, I need $2.5 million? What do they want to understand around that why?
I think I've been lucky because I have a background in innovation. So I studied innovations, how they come about, and how they diffuse across society. And what I understand about them is they arrive in waves. And it's not about just being the right person or the right team, but it's also about picking the right idea at the right point in time. Because VCs are also looking at how innovations are diffusing. And if your idea, you're pitching it at a time when it is uniquely possible, then you actually have a shot of being that team that brings it to market. So I believe that ideas aren't really unique. Many people can come up with the same idea. And it's the VC money that gives you that gunpowder that allows you to go to war with the rest of the world. And you need to have the audacity to say, yes, I'm the guy or girl who's gonna do this and who's gonna beat all the other people who are gonna try win in the same game. Whether that was a social media platform or today there's Frontier Labs developing AI models, or whatever unique combination of emerging technology. I think it's basically identifying the wave and pitching yourself as the right surfer for that wave. So that's what I think VC money gives you. It's like the gunpowder to build your army, to go, fight against the rest of the world who also wants to take that slice of the pie. So yeah, everything I'm saying sounds aggressive, and I think you need to be aggressive when you're going into a VC-backed startup environment, which can be stressful, but it can also be exhilarating and very high growth in terms of personal skills and development. So yeah, it's not for everyone, and I wouldn't recommend it to everyone, but I enjoyed it, and I also burnt out from it. So yeah.
Now,
Wait, let me build on that.
go for it, yeah.
So what I take away from what you say is there's two things: a good story and someone who can actually tell the story. So maybe charisma, right? Because if you don't have these two, then you cannot convince the person who makes the decision. And I've been on the other side of making the decision where um, I had a bunch of founders that try to come and pitch and that want to come and fundraise, but only, I would say maybe 1 in 10, 1 in 15 passed me. That I actually pass this to the management, that we make the decision. We are going to fundraise for these people. And it comes down to exactly what you say, a story that you believe in that's related to a trend. Because if the narrative of the trend is not there, then why would you even care? The valuation is something else that's very important, especially as an investor. And then the charisma. If a founder cannot really express his vision, then like that already directly dilutes my trust, to be honest. So yeah.
I'm actually very glad that you said that because I really did want to take this towards your unique perspective in, let's say, performing due diligence and evaluating businesses on whether they get to pass the next step towards venture capital funding. And it's funny that you mentioned, this charisma as well, and Luca had brought it to our attention because I always joke in trying to simplify the concept of like trying to fundraise for your startup. If you are a startup founder and you're trying to raise money, it's very funny. If you find the right person and you make the right combination of mouth noises in the right order, they will give you money. And so this is a very simple way of trying to figure out how to break this code. But from your perspective, this is taking it back to the kind of vibe coding era that we're in. And Dan mentioned something very interesting around his friend who started a new venture capital fund under a completely different model in which they're essentially providing a marketing budget. And that might even look like venture debt, which we'll get into a little bit later, but for a revenue share. And so when we're talking about companies nowadays that some people might be vibe coding or building together, the entire list of fundamentals that govern a business that we look at as an investment change entirely. And so what do you think is very important from an investor perspective to evaluate a business, whether this is something I want to invest in from a business that is built on a vibe-coded product today?
I mean, I think in the first place, even if it's a vibe coded product, if a founder or a creator can get users onto their app and can show for real revenue, then there is potential. Because 99% of the apps doesn't get any users or any revenue. So if you get there and someone can show for it, then money can maybe make the difference in actually getting that thing to way bigger, like 100x. And 100x opportunity, that's an investment worthy opportunity. There is return on investment. And if you what you said about the ref share, that's actually a nice model and reminds me of like basically return on ad spend, right? Like then it becomes a numbers game. It's like, okay, how much can I get from you to then invest in marketing to get return? And if that's a 3x return, awesome, right? Because then everyone makes money. So yeah, I think it's a combination of these two. It's if a founder or a creator can actually get users and revenue, awesome first step, investable potentially if he wants and if he needs. And then the return on ad spend or return on capital. Yeah, that's, I think, the way or interesting way to approach it.
Absolutely. I agree wholeheartedly. And I think this is a good time. I wanted to kind of keep the VC discussion for a little bit later, but I think it's a good time to get into it because we're already touching on it a lot now. And, Dan, I kind of wanted to hear your perspective on this. We've been seeing a lot of evolution around the venture capital landscape. Some way more notable VCs, for example, A16Z, that have really started to change their thesis. And Mark Andreessen, one of the founders of A16Z, has been speaking way more profoundly around vibe coding, LLMs, and AI technologies in which they can enable a marketer to be a product engineer to be a marketer, and anything in between. And so we've been seeing the way that these people invest change quite a bit. And one of the more notable examples that comes to my mind is a company called Cluely. I'm not sure if any of you are familiar with Cluely, but it was a company that went quite viral over, I think, a year ago. They were invested in by A16Z, and it was essentially a chat GPT wrapper that was installed on your computer that kind of hung out in the background and listened to conversations on Zoom calls or whatever, and it was marketed as the cheat on everything infrastructure. And one of the big reasons that A16Z decided to back this company is because it went viral. there was a huge marketing reach and brand awareness. And I think this is a big lesson to take from this, because if you're developing a product, all of a sudden you know that investors are looking at different things now, and that might be marketing virality. So in your opinion, what are some of these new types of fundamentals that you think are becoming more important, things that are not so clearly tied to profitability or revenue, but they can be seen in that way strategically?
So I have quite a contrarian take on this one. I hope you will humor me. My experience with VCs, right? I once spoke to this man, a UCL postdoc researcher who came up with a new way of diagnosing, can't remember if it was like age-related macular degeneration or glaucoma or something in the eye. Amazing new technology, incredible for like healthcare, would make people's lives better. Insane. The guy had every credential in the world. Couldn't raise. His name was Ahmed, right? So he told us when we spoke to him that he had, in his words, much better luck raising from brown people. These are his words. Now, I've seen this over and over. It happened to me. My first VC-backed startup, Medwise AI, my co-founder. This startup is still alive, by the way. I'm hoping it will exit one day and I'll make some money out of it because I took basically no salary. Anyway, my co-founder, Keith, he's from Hong Kong. Guess where our first angels were from? Hong Kong, of course. Who else would invest in a yellow person? A yellow person. So there is a lot of this in this world. So a lot of what you see online, I feel there is an underlying model to it that you might not be aware of. You might, assume that the external look of it is the reality, but behind it, there are many layers. So one of them is literally network. Who do you know? So my friends in Silicon Valley, and I'm not making this up, this is two separate people who have told me in separate occasions, they raised money because they took acid with the right investors at Burning Man. Right? Right? She confirms. Right, third person. So that's one. Another one is, how do you raise money in Silicon Valley? Be Asian, drop out of Stanford. If you look at people's backgrounds, this makes it so much more likely that you will raise a double-figure million round. No questions asked. The guy who made Cluely, guess what ethnicity he is?
Asian, and he dropped out of Stanford, I think, right?
Boom! Thank you very much. So it's not him. It's like
Such a spicy take.
It's just so common. Come on, just look at the statistics, right? So that's Y Combinator. Now, Y Combinator is its own mafia, right? And many of my friends have been through Y Combinator, and I'm very happy that I've had access to that world through them, like to understand a little bit. And of course, all of these people are insanely smart, super hardworking, right? But the core of it, right? There is a certain clique. You have to be in the right circle, know the right people, and they like you, right? So that's it. That's why A16Z invests in these guys, because they are cool, because we all want to be cool. We want to be in the cool group. These cool people sell their fund. Now let's talk about VC. So VC is its own business, right? And their business is not to invest and then make big returns. The real business is to sell the idea that they will invest and make big returns. The business is to take 2% of the fund per year plus 20% of the exit when they sell, right? That's the standard one, 2 plus 20. Some funds are 3 plus 30. It depends on how famous the fund is. A16Z, I think, is 3 plus 30. But anyway, my point, these people make so much money by raising money and managing the money that this is their incentive. Their incentive is to raise more money all the time. How do you raise more money? Talking about how successful you are and look how cool our shit is and it was in the news and you want to be a part of this, right? This is how they raise money. So, I can't remember your original question. Can you repeat? Sorry.
Well, I don't even remember the original question, to be honest. I'm just like captivated. I agree with some of what you're saying, but at the end of the day, like when it's all the dust is settled, the fund needs to demonstrate that it was able to meet expectations.
The dust
so I understand.
Settles 15 years later. The normal closing time for a fund, if you look at most of them, is 15 years. So you start A16Z Fund 1, start investing. By the second year, you're raising Fund 2 already because you already deployed capital. So you're raising the next 100 million, 200 million, 500 million, 3 billion, right? And then the next year, another fund, next year, another fund, the next year, another fund, right? And in the meantime, you have some exits, and they look good. A16Z returns, I don't know, 3x or something. I can't remember the multiplier. Like, this is made up. I don't know the exact multiplier, but return the multiplier. The median fund returns less than 1x worldwide. The median VC fund loses money for the investors, not for the fund managers. For the fund managers, it makes a lot of money, right? So be very skeptical, I think, of all of these headlines that we see. One more thing, and then, sorry, just one last thing. I've recently looked into this because I was wondering what's going on with VC. My friends in VC are telling me they're paralyzed. They don't know what to put their money in because tomorrow OpenAI will come and just wipe it to zero. Right? All the vibe-coded stuff, all the wrappers of ChatGPT, they're gone. All of that investment of millions and billions doesn't matter. It's all zero now, right? Because ChatGPT brought in the future, right? So there's a lot of that. So that's one. And the other one is the actual amount of VC money keeps growing, but it goes to the winners, right? So A16Z, Sequoia, all these guys, 401 billion VC last year, right, in money raised. But where does it go? Well, it doesn't go to the Vibecoded app, right? That's kind of like side. Anyway, that's me. Sorry.
Well, funny enough, like the majority of the 400 billion and I think 237 billion in the first quarter of this year did end up going to the major LLM developers, Google, Anthropic, and OpenAI. And so they definitely skew the curve. But there is a lot of capital still being deployed into startups that are AI tangential, or they're building applications on top of the AI. And I do disagree with some of the VCs that you spoke about saying that ChatGPT is just going to clean house and spin off all these competitor businesses to kind of overtake the market that these wrappers have created. I don't see that happening. I see these companies having their own financial issues and infrastructure problems, but really serving as the sort of foundational layer for companies to build on in the long run, much like how cable internet replaced DSL. So I think that there is still incredible opportunity to build a startup and grow it and turn that into a great company, and that's exactly why we're sitting here today. I do appreciate your take regardless, but with what you had said in mind around how we need to be more aware of the VC cycle. Usually it's 10 years. And so a player like A16Z might be taking liberties and saying, like, we are so successful, we are seeing the best returns, we are going to do all these amazing things, give us your money, but it's only been 2 years into the 10-year cycle. That does mean there is opportunity to try and play this game and essentially cater to what they're looking for. And with that in mind, I wanted to ask you, Luca, because you've been getting way more into thinking about how to virally create your own brand identity and tie that to a business in a very non-conventional way. How important do you think it is today to market yourself in founder-led content, market yourself in other unique ways, market all of these strange things that can eventually tie to your business and gain more notoriety for your business, so that investors can believe, oh, there's real community and traction and awareness around this?
Yeah, and I want to preface by saying, like, okay, I'm white, but I'm also maybe 170 centimeters tall. So I'm not like a tall white guy. I'm a short white guy from the smallest country in Europe, Malta. And we have the least amount of venture capital. You're laughing, but like, this is the truth. Like, I mean, potato, but I come from a disadvantaged country when you look at the rest of Europe. We have the least amount of venture capital flows. We don't have a single venture capital firm that's from Malta, so there's no Hong Kong investment happening. I had to go and beg to people around the world. And one time I found a VC capital firm, and it was advertising itself to founders that come from underrepresented regions on the world. And everyone on that VC board was brown. But I still applied, and I turned up at the VC firm, and I told them, hey, like, I know maybe is this the right place for me? And I explained to them, I told them, I feel underrepresented because where I come from, there's no venture capital coming into my country. So you guys are marketing yourselves as representing underrepresented founders, and I'm wondering if I have a shot of getting funding here. And I'm saying that because I believe that the venture capital that was invested in me allowed me to grow as an individual. And it didn't just allow me to grow, it allowed the rest of my team to grow with me. The people who were a part of my team, after that company ended and eventually failed, went on to start their own companies because they had got a taste of the startup life and there was no going back from that. And I believe everyone should have a shot at that. And I wish everyone has the audacity to go and ask for it and doesn't think that just because they're not from Silicon Valley that they have no shot at getting their chance. I want everyone to have that chance. I've donated, a couple €1,000 to friends of mine who want to open a barber shop because I believe that, even a barber should have his own chance at starting his own company. Because I believe that when you work for yourself and you create your own value, that brings you dignity in your life. And I would not change anything about how I've lived my life.
Wow.
Yeah, but your question was.
We don't even have to go back to it because that was so profound. I loved it. But thank you for sharing that.
Yeah.
I'll answer his question.
Rik, I wanted to, if you don't mind, give me an answer there, and then I wanted to talk to you specifically around incubators. But yeah, please.
Well, yeah. So your question was about founder-led content and something like investing in founders.
Like understanding how important it is
Understanding
to
attention.
think more uniquely and creatively around marketing yourself, your own brand identity, and essentially being part of this game now that many VCs are looking for, because VCs can't demonstrate a return on your company, and most traditional companies don't see returns when they exit for 3, 5, 7 years. So now they have to play some different game to try and keep this speculation going. And that game might be how well we're marketing, how much we can market our success. And it's just maybe these little wins along the way and how far our marketing reaches. So give us your opinion on how important you think that is today.
Well, I think this example of Cluely is the perfect example where everyone now knows Roy from Cluely, right? And I'm pretty sure A16Z invested in Roy from Cluely, not in Cluely the product. And they will continue investing in the Roy ecosystem, whatever Roy puts out. There's gonna be attention, and it's like investing in the attention economy. I put money where attention goes and flows. It's the same for both product founders as well as VCs. Ashton Kutcher is one of the most successful had one of the most successful VCs in AI investing. He walked away from that fund, now starts a new fund, and he can because he has the name and he has the attention. So he built his own ecosystem, his own universe, and people know the name, so people throw money at it. And if you can get to that point of people know your name, so people will throw money at you, people know, they understand that you will be able to generate attention, and the attention will be turned into revenue, users, whatever. Another way is if you're a founder that doesn't really have attention, but you have the network and you know certain people that are able to generate attention, you can always give part of your product or equity to someone who can generate attention, and you run the product together. Like, let's say I know 2 famous influencers that are related to the product I'm building. I give them 20% of my company, and they generate attention. So they get the revenues, they get part of whenever we exit. So that's another way that this could be played. And I've been thinking about this too. Like, if I don't generate the attention, maybe I should find 2, 3, 4, 5 people that actually that are related to the products I'm building, and take it from there. Because then I think that's way more valuable than trying to do it yourself.
Yeah, it's actually really funny because there are a number of VCs that have recently come to market that are backing only what we refer to as KOLs, key opinion leaders. And the thesis is quite simple. We're going to invest in companies that are creating consumer-based products and services because all these people can market it to consumers on YouTube. So it's very interesting to think specifically around this user journey. I wanted to ask you, Rik, around incubators and accelerators, because you have a lot of experience in incubators. We're kind of pivoting this conversation a little bit to try and offer maybe some more practical advice for people that might be thinking, it's become more clear, maybe the VC path is not really for me. Many people are unfamiliar with incubators and accelerators. I myself have mentored in a number of accelerator programs. We have an incubator as well. I know, Dan, we were speaking earlier, you've been a part of a couple of accelerator programs. And I think this offers an alternative, but also a very unique path towards funding as well. These don't come without drawbacks, though, and it can be a tricky landscape to navigate. But from your own opinion, what do you think are some of the pros of maybe joining an accelerator program, and what are some of the cons or cautions that you could approach them with?
Well, I think that if you're building something, a product or yeah, like a service, whatever, you know some things very well, but some things you also don't. And it takes a lot to figure everything out yourself, or you need a great co-founder, or you can join an incubator. And they do have the network, they do have the marketing knowledge, they do have certain investor introductions that they can make or other introductions for services if you're lacking these. And I think that's the benefit or the value that an incubator can bring, because you cannot do everything yourself, and it's going to probably it's going to be a wasted opportunity if you got to figure it all out yourself. So you can try to figure it out yourself, and I'm someone who likes to figure it out myself. Um, but I think that's the value of an incubator, where you can tap into knowledge that has done it before, and therefore you increase your chances to actually reach your goals if it's the right fit. Because that's the more important one, because there's a lot of incubators out there that are a bunch of bullshitters on itself. So yeah, and that's why I'm kind of staying away from it. Because I've seen the ins and outs. I've talked to a bunch of incubators myself. I've been part of some, and sometimes they just put interns on board of marketing departments, and then you got to trust those interns. Well, I guess that's not always the best way to go.
Yeah, absolutely. I've got a follow-up question for Dan around accelerators and incubators. From someone who has been in 2 accelerator programs before, for approaching a company, a venture fund or an accelerator that's going to sit there and tell you, I'm going to offer all of these services, I'm going to offer all this expertise, I'm going to connect you with investors, I'm maybe not going to guarantee any funding, and in return I want 7% of your company. What are some things to keep in mind for maybe understanding if this is right for you, but maybe more importantly, getting the most value out of an accelerator program that you might enter into?
Right. Well, my personal story is a bit more complicated than that, in the sense that I didn't join an accelerator with an established team, with a clear product, with any traction. I joined as an individual. Like, the 3 times I've done this, it was always, so it was EF twice, and then it was Zinc VC, also in London. So the whole point was, I want to start something, I need somebody to start it with. How do I meet this person, right? And so these programs, they call themselves something else, not accelerators. They call themselves talent investors, for example, like EF. I loved it. And it's like almost risk-free because you get paid. This sounds almost like an ad, but it really is very good. I enjoyed it. Basically, you get like $2,000 a month or something to just hang out and try to meet the person to start it with. And if you do, then you have to pitch to them. And if they like it, then they invest in you immediately. You get like something like $100K approximately ish. They claim it's a lot more, so that your valuation goes up. But then they claim it's a lot more, but then you have to pay them money back for services. It's an interesting tax scheme. But anyway, that's too many details. But the point is, I loved it, and I thought it was very useful in my personal case. Now, if you do have an established team, business, whatever, like it's already working, right? And you just need to accelerate it, hence an accelerator, right? Does it make sense to leave 7% of your company and sign crazy terms? Because it's not just the percentage. Oh, I give 7%. No. You also sign terms that say you can't hire whoever you want until they approve it. You can't pay yourself more than X salary until they approve it. You can't sell the company to anyone until they approve it. This is all terms that you sign, right? Sometimes even crazier stuff, like if you leave before like the first year or something, you leave with nothing, even if it's your own company, like the vesting schedule. Like you sign a vesting schedule where you would leave with 0, which makes sense if you start from 0. It doesn't make sense if you start from 10, right? And then you give it all away to some accelerator, So obviously look at the small print. And then everything is in context, right? It depends on what options are available to you at that point, right? You're playing this, Warcraft game, whatever, StarCraft, and you're exploring the map. Right? You don't know how to get to where you want to get. Maybe you know where you want to get, but have no idea what the terrain looks like. So as you are exploring the map and you are, diffusing the fog of war, the darkness, well, then you make the choices, you make the decisions at the step where you are. I think that's makes the most sense.
Absolutely. That's very practical advice. We're starting to get into alternative funding paths now. And I know we lingered on venture capital a lot because we talk about it so much. I'm sure many people talk about it. They wonder about it. But now we need to start really thinking about how can I bring on some capital for my startup at an early stage in a different way. You've got, giving away parts of your company. You've got maybe, committing to certain terms. But then there are some other ways where maybe you give away less because the value that's being offered is of a different form. And I want to take this question over to Luca because you have worked very closely with the government of Malta across a number of programs. You're actively engaging with individuals within the government to maybe kickstart a number of programs that are close and peripheral to, let's say, a startup technology, digital nomad culture, etc. And I think you're very well equipped to answer. Give our audience members and anyone that might be watching or viewing, what are some ways to think about non-dilutive funding? Because many people don't think about maybe getting funding through a government program, a research grant, an ecosystem program. They might not believe they're eligible for this, but in fact, it's way more accessible than many people think. And it all comes down to context of what they might be building or who they might be building it for.
So this is where actually I diverge a lot from the reality of Malta and the rest of Europe. Is most of the funding available that's like non-dilutive is all going into research grants, and we have this thing called like the MCST, the Malta Council of Science and Technology, and a bunch of other programs that I never successfully applied for. And I've applied to a lot of them or tried to and got lost in the paperwork. And this is where I wish Malta and the rest of Europe actually changes. And instead of giving these grants out and creating schemes that people need to adopt their business to adapt to so that they successfully win some grant, I wish we did it more like the Americans do it, where you have portions of pension funds, portions of taxes that are flowing into local venture capital firms who ultimately decide to write the checks and can do it on a much faster basis, on a much much more educated basis, because they actually know what's trending and what's happening. And when things are going through government, things are always lagging behind. Unfortunately, you have companies in the EU like Mistral who should be leading the way for Europe in the AI space, but they've only raised 1.3 billion, which might sound like a lot to us, but when you compare to the hundreds of billions that OpenAI and Anthropic and DeepSeek have pumped into them, it's nothing. And then you've got huge companies like FluidStack that were going to build the best data centers Europe would have had, relocating over to the US because the US VCs are cutting them checks so much faster. So this is what I wish governments would do, is they would identify capable people who are ideally have a founding background, they've been entrepreneurs themselves, and now they're raising their own venture capital funds, founders funds, and they give them the money to go and invest in the local startup scenes. And this is what I lobby for, what I hope to see happen, but it's going to take some time. But yeah.
Absolutely. And Rik, I want to ask you specifically around ecosystem grants, because you're living very much in the product and consumer focused space. And you have a lot of experience in the world of Web3 and blockchain, where we saw a lot of capital being thrown around in the form of ecosystem grants. And as using that example, like let's say a blockchain network would have a grant program that would offer $50, $100, $500,000 to somebody that might be building on that infrastructure with the hope that the value will eventually come back to them in some way. And taking that kind of philosophy that was very much copy-pasted from the blockchain space into what we're seeing nowadays for, let's say, payment infrastructure providers with like product landscapes, product ecosystems. What are some sort of like tips and tricks that you might consider if you're starting a product, if you're starting a new company and you're building on top of like AI infrastructure and you have like a transaction infrastructure as well? How would you approach this sort of strategy for non-dilutive capital?
Well, I feel like if you're building an AI, then there's not really these grants, or I'm not aware of these grants as they were in blockchain. So if I would recommend something, it's go find a chain that's AI focused and go after their grant program. We have a common friend who won a hackathon recently for a chain he really didn't care about, but I think he won like $70,000 worth of tokens, which he could sell straight away. So that's just by participating in a hackathon where there was like only 10 other people, barely any competition, and walked away with a lot of money for his startup. So that's like initial funding, boom, you have it, right? I'm not really aware if like OpenAI or Anthropic would be cool if they did this stuff. I know Sam Altman offered every YC startup $2 million worth of tokens. That's an amazing Kickstarter, right? And I no, it is. I double checked after you gave the comment. Yeah, it is actually. So it's just a lock-in in the ecosystem. It's not, they don't take any part of the company. So I don't really know. I would say like I wish these these easy grants, or like I've met a lot of people that actually did this, like go grant after grant after grant and get funded that way. I never really looked at it, to be honest. So maybe it's a missed opportunity for me.
Well, I mean, for those of you that are listening and thinking like, how can I bring on some capital? I don't have to go this VC route. I don't have to give away pieces of my company. There's an entire business. This will give you an idea of how prominent this is. There's an entire business of service providers that can work with your company and apply to 50 or 100 grant programs in exchange for taking some of that grant money that you get. And so there are a lot of programs out there. It just comes down to looking for them. And it is, like Rik said, as simple as an application. In fact, I work with a number of portfolio companies that actively pursue grant programs, and they brought in over $500,000 across 3 companies over the past year just by applying. And the philosophy there is that they will take this grant money, they'll integrate, for example, Stripe. And because they're going to commit to using Stripe, for all of the users that they'll bring on over the next year or 2 years or 3 years, all of those transactions will settle onto Stripe, and they'll push that infrastructure onto their consumers, so Stripe's customer base grows. And that's kind of like how these grant programs work. I want to kind of begin to wrap this up a little bit, and I'm going to wrap it up with one more question before we go through like a lightning round. And I'm going to ask it to you, Dan, because you're building specifically agentic infrastructure on AI. And apart from non-dilutive funding, there are other ways to get value for your startup. And I think Rik mentioned a very good one around OpenAI tokens. And there are a lot of companies, as an example, AWS, Alibaba Cloud, Google, Cloudflare, a lot of them that offer cloud service credit programs, because nowadays if you're building on AI or you're launching cloud infrastructure, a lot of your expense is going to be cloud tokens, etc. And there are many different ways in which you can kind of get this value through similar applications on grant programs. In fact, one of our portfolio companies that I'm supporting just submitted an application to AWS last week and got $25,000 in cloud credits the same day. So Dan, if you're starting your company over from scratch, I'm sure you've already applied to a number of these programs. What would you do to try and get the most value out of the idea of a startup that all these companies are looking to like bring in?
I mean, you just answered that question, so I'm not sure. I mean, apply to all of them, obviously. Tell a good story to each of them, of course. You have to be a bit present. You have to be a bit involved. You have to have, person-to-person communication. There will be some person that will onboard you to the program, that will be your point of contact, like be nice to them, that whole thing. Basically, it's people talking to people, right? And you're right, there's all these programs. I am lucky that a friend of mine got it through his recently VC-backed startup, got 150K from Google, and he doesn't use them, so he just gave them to me. So I'm just burning Google tokens, for example. I just wish Gemini was better, so I would have a better reason for burning them. But yes, I was offered by people at AWS to apply and get a minimum 5K, 20K, what you mentioned is like the sort of the North Star, but it depends on you have to present it to them. You have to put together this dossier of like how that will grow and why it's great and why you will stay with AWS, etc. So I guess it's exactly what you said. I just repeated it, but longer.
All right. Sorry for taking your thunder.
No,
I think, but you made a great point, right? It's important to think about the narrative that you're going to approach these companies, you should give me $100,000 in credits for this type of grant because you're going to make $500,000 when I bring in all these different clients and it's all operating on your infrastructure. And just some more context for those of you that are out there listening around how can I get more value. It's not just cloud credits, anything from, like I said before, payment infrastructure. Stripe offers startup programs where they give discounts on transaction fees. CRMs like Notion, Monday, etc. offer 50 to 90% discounts specifically for startups. Banking, neo-banking, any of these types of infrastructure platforms that you operate on a normal everyday basis, they all have startup programs. So this is something great to explore.
And don't forget crypto competitions. This is why we should all be going.
Actually, they might just turn you away if you mention anything about crypto.
Not if you mention them in the competitions.
That's true. That's true. So let's go through a quick lightning round, and we're going to kind of wrap it up the way that we started. Let's go through and give a quick answer. If you were starting a company today, doesn't matter what it is, would you seek funding for it? Yes or no?
Nope.
There is one idea I have today that I'm going to raise for it in the next 12 months if I manage to put things together. But it's like I have one thing that it's a lightning round, but I have one thing which I don't need to raise for, and that's what I'm operating today. And then I have this one other idea that's like a moonshot, you know. The chances I succeed are so slim, but I'm gonna try anyway because I still have the energy and I want to give it another shot before I get old, you know. And tired because it's tiring, you know.
No for vibe-coded apps, yes for real businesses.
Interesting. I think the takeaway is pretty clear, right? There's no one size fits all. Everybody's startup journey, everybody's company, the product or service they offer behind their company, and the users or customers that product or service is targeting, it's all a completely different situation. So it's not a one size fits all. You really have to understand your own business. And again, going back to the why you'd want to grow it, onboard money to do so, and then scale it once you've onboarded money. I'd like to thank all three of you again, Dan, Luca, and Rik, for allowing me to host this panel and ask you all these fun questions. And thank you so much to everybody for joining and listening patiently. And I hope you guys got some great lessons out of this. So thank you so much for joining, everybody. All right.
Nice.
And again, I really appreciate all of you coming and taking some time out of your Friday. It's Friday. It's been a long week. We've all worked our asses off because it's Bansko. That's the Bansko vibe, right? We can't stop working. But yeah, please enjoy yourselves. We've got cold beers in the fridge. We've got more food. And yeah, just hang out. And we're going to wrap it up in maybe like 10, 20 minutes or so. So enjoy the rest of your Friday. Much love, y'all.
Thanks, Sasha.
Good job.
Thanks, bro.